So good morning, everybody. Welcome to another Tech Tribe community masterclass. Very excited about this one this morning. It's all about financials. It's part of our theme this month in May and in June about the ABCs of startup financials. And this is hosted by the Moolman Institute. So please, in the comments, say hello, let us know where you're from and what you are hoping to, or what you are expecting to get out of this workshop or this masterclass. I'm very excited about my guest. And I'm sure many of you have questions about net present value and internal rate of return. Things I've heard, words I've heard, no clue what any of it means, but I know that they're financial metrics that will help you value your business and your technology and also help you make financial decisions when it comes to your business. So I'm very excited to introduce Dr. Sean Moolman. He's the founder and CEO of the Moolman Institute, and he's our host this morning. A little bit about him and the Moolman Institute. It's an online learning institute that's focused on technology commercialization and innovation. There's a whole bunch of courses there about entrepreneurship and technology, et cetera, et cetera. If you want to go to the Moolman Institute website to go check that out. And Sean is also the co-founder of Power Optimal, an energy technology company, and the director of several companies. And he was previously the head of technology transfer at the CSIR. Also has a PhD in chemical engineering from University of Pretoria, and completed a management advancement program at Wits Business School, is a registered technology transfer professional. So we've got an expert here today. He's going to explain all of this, and I'm excited to learn and understand what all of this means. So without further ado, I won't take any more time. Over to you, Sean. Welcome, and thank you very much for joining us and hosting this workshop.
Thank you, Tari, and thanks everyone for joining, and thank you to SA Innovation Summit and the Tech Tribe community for the opportunity. I believe in lifelong learning, so I think there's a bit of background noise there. Thanks. I believe in lifelong learning. I certainly don't believe I know everything. In fact, the more I learn, the more I understand how little I know. So, maybe I'll learn a little bit from you guys as well if we have opportunity today. But yeah, so I'm very excited to present this masterclass series on the ABCs of startup financials. Financials can be a pain for some entrepreneurs, but I think you have to accept that, it's a core component of your business. Without the financials, there is no business. And the profitability, the ultimate profitability of a business is really the scorecard of how well you run the business. So the financials is a component of your business, is unavoidable, but rather than look at that as a drag, you can look at that as an opportunity to understand your business better from a financial perspective. And obviously, we can't cover everything in this masterclass series, but we're going to try to cover a few of the fundamental concepts and try and give you a few tools, a few basic tools that you will hopefully be able to use for the rest of your life. Not just in your current business, which is hopefully going to be a huge success, but any future businesses you may start, and even in any other areas of your life, making decisions on home loans and whether to buy a car and investment decisions personally and all these sorts of things. The Tech Tribe team will share the slides with you afterwards, so there's no need to try and make a lot of notes on this. It's much better if you just focus on what we discuss and take as much in as you can from that. Also, there will be opportunity to ask questions at the end, hopefully, if we have time left. But also, you're welcome to type some of your questions in the chat, and we'll keep those questions and answer them at the end. And some of those, if they are really pertinent, we'll cover them, right there. So please do ask questions. There's no such thing as a dumb question, because usually what you're wondering about, quite a few other people are also wondering about. And if you're the brave one asking the question, you help a lot of people through that. So yeah, let's get going. This first masterclass in the series is about how to do financial evaluation using net present value and internal rate of return. And as Tari said, you probably heard this terminology before. Hopefully, I'll try and give you a better understanding of what it means and how you can use it to do your own financial evaluations. So here's what we're going to cover today. I'm just going to give you some background and context why we look at these two financial metrics, net present value, internal rate of return. I'll also then do a refresher on some key financial concepts that you need in order to be able to understand and calculate NPV and IRR. Then we'll cover those two financial metrics themselves. And then we'll do a few examples. I'll do an example, and then you'll get the opportunity to try and do some calculations yourself. And the Tech Tribe team is going to help me put you into groups. So you're going to be allocated into a group of 3 or 4 people. We're going to have a question put to you, and then you'll try and work out the answer to that. And then we'll cover some of the limitations of net present value and internal rate of return. Like any financial metrics or any models that you use to model anything in life, a model is only a model. It's not the full reality. There are simplifications in there. There are assumptions in there. And that means that any single metric, any single model will have some limitations. So it's important to also understand the limitations of these metrics so that you don't use them in the wrong way or in the wrong application or environment. And then I'll also very quickly talk about how you can overcome some of the key limitations of NPV and IRR. Right, so let's kick off with the context. The big context really for a startup and for an entrepreneur is that you have to make a lot of financial decisions. You have to decide on things like, should you rent or buy different assets? Should you lease or buy property? Should you outsource or develop some things internally? Should you borrow money or should you try and raise investment? Should you employ people or should you contract them or contract other companies? Should you license in intellectual property? Should you buy intellectual property or should you try and develop around other people's intellectual property? And then a big thing that you have to think about, or that you encounter a lot and that you have to make decisions around, is you have to think about the financial viability, the profitability, or the attractiveness of various technologies. Sorry, there's somebody. Thank you for the mute. Technologies, products, and services. You know, you have to assess different business models, different market segments, and you have to assess the financial viability of your company. You need to understand what are the levers of profitability that will drive profitability in your company. So really, you have to make these financial assessments or do these financial assessments in order to inform what things you focus on in terms of research and development, what products and services you plan to develop in your company, and really your whole strategic focus. What target markets what market segments you're gonna target, and so forth. And then if you assess the financial viability of your company, what you're really doing is you're doing valuation. You're valuing the company, the technologies, the products and services, and so on. And this directly impacts the valuation of the company, which directly impacts when you raise investment, for example, how much equity you have to give away for how much money. And of course, you know, valuation is a huge topic. This masterclass will not cover valuation, but it will cover the fundamental building blocks that you use in valuation. When you do a valuation, generally you will use concepts like NPV and IRR to do the valuation. So today we're going to give you the building blocks or the tools for your toolkit that will enable you to do valuation for your company, but we'll not go into valuation itself in this masterclass because it's actually a huge topic on its own. But you'll definitely learn about the key concepts that you need in order to be able to do a valuation. Okay, so on that point, you notice that the title of this talk is financial evaluation. And the word evaluation and the word valuation, those two words are very close, and that can confuse a lot of people. But a good way to think about it is to substitute the word assessment for the word evaluation. Then it might help you to differentiate between what the two means. Assessment is an overall picture of everything that you need to consider, not just the financial aspects, whilst valuation is purely a financial exercise. And I'll explain the difference using an example of a patent. So if you want to try and determine whether a patent is valuable or how strong a patent is, you will do an assessment or an evaluation on a patent, and you will look at different things. You will look at quantitative measures as well as qualitative measures. And just if you don't know what those words mean, quantitative means to do with numbers. In other words, you're trying to put a number or different numbers, or you're measuring something, a quantity. whilst qualitative means more intangible things that you can't touch. For example, is the patent granted or not? That's more of a, well, that's a yes or no decision. But let's say, is the field that the patent is in attractive or not? That's more of a qualitative question. Or how strong is the team that can develop the patent or that is commercializing the patent? That's more of a qualitative question. That's not easy to put a number to, or to put one number to, or to measure quantitatively. Okay, so when you're doing an assessment, you think about quantitative and qualitative measures. And on the quantitative side, you have monetary and non-monetary. So to do with money and to do with other metrics that you can also put numbers to. So other measurements rather than money. And then you have qualitative measures, and this is not an exhaustive list, it's just examples, but you will do a due diligence on the patent. You will look at whether there are any encumbrances, in other words, whether other parties might have rights to the patent, whether there's freedom to operate, whether the IP is infringing on somebody else's intellectual property, you know, the ownership rights and all of these sorts of things. Are all the agreements in place? So all these things, you know, is the patent application filed? Is it valid? All these sorts of things are qualitative things that you'll use to assess a patent, and it's called due diligence. And then you can also do something called rating and ranking, which is just, you know, ranking from the best to the worst. And a very familiar method of rating and ranking is ranking of websites, which is what Google does. So every time you type a Google search, Google ranks the websites according to what it thinks is the closest to what you're asking for. On the quantitative side, you can further break down from a monetary perspective. There are different ways to quantify the value of a patent. So these things are called, this is what valuation is. There are different methods. Some of them are cost methods, some of them are market, some of them are income methods. So for example, cost approach is, how much did it cost me to develop this intellectual property, or how much will it cost to replicate it or to circumvent it, to work around it? The market methods in valuation look at what similar technology has achieved in the marketplace. What value has similar patents or intellectual property, you know, how much has it been sold for in the market? If you can find that type of information, that's useful. And then there's the income approach, which is where the metrics like net present value and internal rate of return are used. So that's where you look at financial projections for your own company. You try and estimate the future financials, the future profitability of your company. You try and estimate the cash flows, and then you use net present value and internal rate of return to value your company and to estimate the financial attractiveness of your company. So I hope that clarifies, makes it a bit clearer what's the difference between evaluation and valuation. So what you'll learn today will be the basic tools to do quantitative evaluation. But remember that quantitative evaluation, there are other decisions like the examples that I just mentioned, where you need to decide whether you want to buy or lease an asset. And that's not necessarily a valuation. A valuation is a specific type of quantitative evaluation. But we will look at using net present value and internal rate of return in general for any type of financial assessment, any type of financial decision that you need to make. Okay, so I hope that helps to give the background to what we want to talk about today, and why we're talking about NPV and IRR, and why these metrics are so important for startups and startup entrepreneurs. So before we get to NPV and IRR, I just want to do a quick refresher on some key financial concepts. The first one we'll cover is really the foundation of all the financial metrics and concepts. So if there's one thing you remember from today, then make a time value of money. That's the most important thing, I think, for the day, the most important concept. If you grasp that, all the other metrics and evaluation approaches, assessment approaches build on that. Then flowing from the time value of money, you have two related concepts called present value and future value. And then we will talk a little bit about risk. And you will probably have a good feeling by now if you some distance, some way down the road with your startup, you know, what risk means, because there's a lot of things that a startup by its very nature is a risky endeavor. But you know, risk does not necessarily just have a negative connotation, because we'll talk later about risk and return and so on. And you know, there's calculated risk and there's sort of dumb risk. You know, dumb risk is where the odds are really against you, like when you're playing the lotto and you know the odds of winning there is minuscule. Calculated risk is when you try and get a grip on what the risks are and you actually try and manage them. When you're playing the lotto, you can't really do anything about the risk there. The level of the improbability of you winning is known. But when you do a startup, everything you're trying to do in that startup is to do with trying to reducing your risk. You the process of building a startup is the process of reducing risk, because when you start off, there's a huge number of risks. You have risks, you have technological risks, you have people risks, in terms of usually you only have one technical person that understands everything. If they leave your startup, the startup is in trouble. You have market risk, you have things like recessions happening, and if you have a product where people only buy those products when the economy is doing well, you know, you have the risk of a recession killing your company. You have the risk of competitors, you have the risk of manufacturability. So there's lots of risks, and what you're doing in a startup is you down managing all of those risks. You're developing the technology, trying to reduce the risks there. You're testing your products and services in the market. If you're doing the lean startup model, that's trying to reduce your risk at an early stage. So instead of making all these assumptions and hypotheses and not examining them properly, you are going into the market and you're testing your product and services with customers, and that's all to do with trying to reduce risk. Okay, and then the last concept I want to talk about then is discounted cash flow. Right, so let's start with the time value of money. So why does money have a time value? I can answer that by, if we think about the difference between somebody telling you that they're giving you that they are giving you R1 million right now, or they are giving you R1 million 40 years into the future. Intuitively, you will understand that there's a big difference between those two, even though the amount of money is exactly the same. And that intuition is the correct intuition. And you know, I want you to try and think why that is. Why is there such a big difference between if you get the R1 million now versus somebody promising you to give you the money 40 years into the future? Similarly, think about if you get a car today, what can you do with a car today versus getting the car 40 years into the future? And of course, there's an obvious difference. The obvious difference is that you can use the car today. If you get the money today, you can use that money today. You can invest that money. You can earn a return on that money. So Investopedia defines the time value of money as the idea that money available at the present time is worth more than the same amount in the future due to its potential earning capacity. So if you receive that R1 million now, you can put it in the bank and earn maybe 6% on a fixed deposit. And that 6% is a little bit more than inflation at the moment. That means your money is growing every year and you're earning something. If you're only getting that money 40 years into the future, there is no earning capacity from now until then. So really what the time value of money is about is the opportunity cost. It's the opportunity to do something with the money. Just like if you receive the car now versus 40 years into the future, if you receive the car today, you can drive around in it tomorrow. You can go somewhere. You have the opportunity to do things. So that really is what's to do with the time value of money. And that's also related to risk and startups. If you think about, you can put money in the bank and earn a return. So that return is pretty much guaranteed. So if you're trying to convince somebody to put money into your startup, what they want to see is a much bigger potential return than what they can earn from putting money in the bank. Okay, so let's move on then. If money has a time value, then you should be able to guess what these terms would mean: present value and future value. Clearly, that's related to the time value of money. If we say money has a time value, then we should be able to manipulate an amount of money to put it in different time terms. If you know that you're going to receive R1 million 40 years into the future, what's the value of that money to you today? Clearly, it must be less than 40 millions. So the definition of the present value is the value in the present of one or more future cash flows given a specified rate of return or cost of capital. I'll explain a little bit more about, we'll go into what this rate of return or cost of capital means. But present value then clearly is to express in today's terms what that future money is really worth to you. And you know that because of inflation, I mean, if you talk to your grandparents, if you have the opportunity to still talk to them and they're still alive, they can tell you about what a loaf of bread or a bottle of milk cost 40 years ago, or what a car cost 40, 50 years ago. And a car, the same vehicle and the same loaf of bread costs a lot more today because of inflation and all of these sorts of things. But clearly that gives you a sense that going into the future, money is, you know, the same amount of money that you might earn in the future will not be worth at that time the same that it is now. So we all have a sense of what money is worth today, but we find it more difficult to relate to what money was worth in the past or what money will be worth in the future. So it's to all our benefit to be able to more easily relate to the value of something if we can express it in present value terms. And that's what we do when we do present value calculations. We convert money that is flowing at some other time in the future back into our present value terms where we can understand. For example, all of you understand that if I tell you I'm selling bread at 150 rands a loaf, then all of you will say, oh, that's way too expensive. Sorry, I'm not buying that bread, because you have an intuitive understanding of the value of money in today's terms. You know, if somebody tells you, you know, please clean my garden, and they say, I'm going to pay you 50 cents, you say, sorry, you know, that's way too little money. If they say, I'll pay you 10,000 rand, you jump and say, I'm doing it immediately. So all of us have a built-in sense of the value of money today, but we don't have a built-in sense of the value of money in the future. That's why we use this tool called the present value calculation to put all the future money back into our current value terms so that we can relate to it and we can understand it. We have an intuitive understanding of it. So here's the equation for calculating present value, where P is the present value, F is the future value, and it's divided by 1 plus some or other rate. It's that specified rate of return or cost of capital that we're talking about, with an exponent here, and that's to the power n, where n is the number of periods, and typically it's the number of years. So if you know a future value 5 years into the future, then that n will be 5. And I'll explain a little bit more about this just now, so don't be too worried about it. Here you can rewrite the same equation. This is the same equation just rewritten to calculate the future value if you have the present value and you know the rate of return or the rate of interest and the number of years. And there's just the definitions of those things. Future value, F is future value, P is present value, 1 plus the interest rate per period, and with an exponent, the number of periods. And for those of you who have forgotten the school mathematics, an exponent means that you just multiply whatever is in the brackets with itself n times. So if n is 1, it's just 1 plus r. If n is 2, then it's 1 plus r multiplied by 1 plus r. And if n is 3, you just multiply it by itself 3 times and so forth. And the process of calculating a present value from a future value is what is called discounting. And the process of calculating a future value from a present value is called compounding. All right, so this rate R, if we are discounting from future to present, we call that rate R the discount rate. And you must have heard of this concept before. This is really at the core of net present value and all of these concepts. It's at the core of valuation. It's what you use in valuation. And I'll say quite a bit more about it soon as well. So if we say that this is the equation for present value, it's the future value divided by 1 plus the interest rate to the power n, then I have a quick question for you, and I'd like you to answer this question in the chat. You can use a calculator or you can use your computer, a spreadsheet. The first one to get the correct answer will win a free course, free access to the online course, Financial Modeling for Entrepreneurs 101. So you can kick off right now. The question says, if the future value is 110,250 Rand, the interest or discount rate is 5% per year, the time is 2 years, the number N, then what is P? Okay, so I hope you can start immediately. First person to get the correct answer in the chat is the winner. Jan Jooste already got the answer. Well done there. Second answer also correct. 100,000 is the correct answer. So really well done. That was super quick. That's good because we have another exercise coming up later, and the rest of you will also get the opportunity. That's when we're going to work in groups. So the group that gets the correct answer first will also win free access to that course. So if I can ask Buntu and colleagues to just make a note, Jan Jooste was the winner of this one. So well done. And for the rest of you that didn't get there, as quick, we'll go through the answer now. So it's a good practice to, let me just click here. If you have any question about time value of money and you're trying to figure it out for yourself, it's always good practice to plot the cash flows on a timeline. So in this instance, we have one cash flow. It's a future value after time 2 years, and you are receiving 110,250 Rands. So if we work that back 1 year, we divide it by 1 plus the interest rate, which is 0.05 to the power 1. We get 105,000. If we divide it again by 1 plus the interest rate to the power 1, we get to 100,000. But of course, you can just insert the values into that equation and calculate it directly, and the correct answer is 100,000. So I hope most of you got this. You'll also receive the document afterwards, the slide deck. So you're welcome to look at it again afterwards if you didn't manage to get it correct now. So there's the saying that compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And supposedly it was Albert Einstein who said it, but as you know, there's thousands of things that have been attributed to Einstein. There's no evidence that he really said it, but supposedly he said it, but that doesn't make it any less true. It's a really powerful concept, compounding. So I want to illustrate it to you. This is a simple graph. If you invest 1,000 Rand now, and you're earning 5% compound interest per year, after 20 years, you'll have 2,600 Rands. But if you're earning 20% interest per year, after 20 years, you'll have 38,000 Rands. And look at that huge impact. And you can see it's an exponential growth. That's why it's so important in your life to start putting away money for your pension or for your retirement or for your children's university or whatever you want to save for. The earlier you start, the better, even if it's very little money that you put away, because then you are earning compound interest. You're making money work for you. When you're borrowing money from the bank for a home loan or for a car, or you buying stuff on your credit card, and you always, or on your Edgars or whatever the latest, on those retail cards, the interest that you pay on there is compound interest. So when you're paying interest, other people are earning exponentially on your money. If you're investing your money, you are making the exponential return. Here's another example to illustrate the concept to you. Let's say that we have a pinball machine, and we project that the pinball machine, we put it in a shopping mall somewhere, and it's earning 10,000 Rand a year net cash flow. So that's after all the costs. And it's growing at 3% per year. Then this 10,000 Rand will have fantastic growth. And here I'm projecting out to 50 years. That's a bit unrealistic, but I'm doing that for a purpose, which I'll explain just now. But so here you can see that nice exponential curve, because any fixed percentage growth is actually exponential growth. So it looks like we're having the power of compounding work for us. But let's take all this future cash flows back into present value terms, and let's discount them at 12% per year, which is a reasonable discount rate to use. And the red lines here are the present values of all these future values. And what you see now is that big amount of over 40,000 Rand 50 years into the future In terms of present value terms, you can't even see the red column there. And that's because it's really worth nothing in present value terms at a 12% rate of discount. And this should make intuitive sense to you as well, because really, how sure can we be that this pinball machine will still be functional 50 years from now? How sure can we be that the shopping mall will still be there? How sure can we be that people will still be interested in playing pinball? Probably not. And this is where you can see that discounting future money can also contribute to considering risk, or bringing in a consideration of the risk factor, because all these big amounts that we are projecting far into the future count nothing when we calculate the present value of those cash flows, the red columns. Really, it's only the first money flows in the first few years. And that makes intuitive sense, because the further into the future we go, the less certain we can be that we will actually earn that money. And that's why venture capital companies, for example, use high discount rates when they discount your cash flow projections for your startup, because they don't have a lot of trust that those big cash flows will realize far into the future. And they shouldn't. You shouldn't blame them for it, because you know as well that it's a high risk endeavor that you're busy with. So I've spoken a lot about risk now already. So let's get into risk. You know, discounting helps to take into account opportunity cost. We already spoke about that. Because money in the future, you can't do anything with it until you receive it. Discounting that future money back to present value terms helps you to take into account the opportunity cost of only earning that money sometime into the future. But as I've already alluded to a lot, discounting also helps to take into account risk. And I want to say something more about risk. We all know that there's a thing, risk versus return. You know, investing in a startup is a different risk than putting money into a bank deposit and earning interest on your savings account. So we know that there's a relationship between risk and return. And hopefully when you're taking higher risk, you get a bigger return. But unfortunately, that curve is not linear. Here's the what the risk versus return curves looks like. So in other words, as you increase the risk, as you move towards the right-hand side, higher and higher risk, you do get a higher and higher return. But as you can see, it's not a straight line going up. You know, you have to take a lot bigger risk to get on average a slightly higher return here on the right-hand side. And then you also have to take into consideration that there's something called inflation, which means money just loses value over time. You know, the same amount of money can't buy you the same thing a few years from now. So if we deduct inflation from the return, then let's say inflation in South Africa is 3%. That means if you only earn a 3% return, your real return is 0%, because that amount of money will only be able to enable you to buy the same things in future than the things you can buy now, if it grows by exactly inflation. So let's look at a few examples. If you put cash in the mattress, it's not at zero risk. You can see it's not on the y-axis. There's some level of risk, because your mattress can burn, you know, your house can burn down, or somebody can break in and steal your money. So it's not at zero risk. And also you're not earning any interest on it. So it's actually below a zero real return, because it's below inflation. You put that money in the mattress 10 years from now, you'll be able to buy less stuff with that money than you are able to buy now. Slightly better return at a slightly higher risk is putting cash in the bank. And cash in the bank is not at zero risk, as you can see on the picture here, because banks can also fail. And we know of the VBS Mutual Bank in South Africa. We know of African Bank that also failed. Even in the US, some banks have failed in the last 10, 15 years. In the 2008, we had IndyMac and American Savings and Loan have also failed. So banks can also fail. When you have a run on the bank, you might find that you can't get your cash out of the bank. Then you have things like government bonds. That's when the government borrows money from people. That's what bonds mean. They pay interest and they pay you back the amount that you lent them at the end of the period. That's reasonably low risk. It depends on what country's government you lend the money to. Some countries might be much higher risk than other ones. And then you have various other things with increasing level of risk, but also increasing potential return. And right at the top here, you can see venture capital. That's the space that you are operating in as startups. So very high risk, potential for high return, but also potential for losing all your money. Because you'll see another definition here for risk is the standard deviation of returns. All that means is that the cash in the bank, you know that it's going to be a certain return, it's 6% or whatever, you know, it doesn't vary a lot up and down. But by the time you get to venture capital, the risk is huge. You might either earn 0 return or you might earn a much higher return than this level. But it's very risky, so the actual return will probably be a lot higher or a lot lower than that level. Okay, so if we understand that the discount rate helps us take into account both opportunity cost and risk, then then we can use that discount rate as a tool to incorporate risk when we are valuing a startup, let's say. And that concept can be called a risk-adjusted hurdle rate, which just means that when the venture capital company looks at your company, what they want to see as a potential return is a minimum rate, let's say 30%, 40%, 50%, that adequately compensates them for their risk. If you're putting financials on the table that says you will earn 5%, you know, the investor will earn 5%, they will say, sorry, I'd rather put it in the bank for 4 or 5 or 6%. I'm pretty sure that I'm going to get that return from the bank. I'd rather not put the money in your startup. They want to see a much bigger percentage return, and that bigger percentage return is what's called the risk-adjusted hurdle rate. And I've already demonstrated the powerful impact of compounding and discounting, but just a different way to look at it. Let's say you have 1,000 Rand 5 years into the future. If you discount it at 0%, then the value now is the same. It's 1,000 Rand. But if you consider inflation, and let's say inflation is 3%, then that 1,000 Rand 5 years into the future is only worth 860 Rands to you now. The risk-free rate, that sort of investment, you know, putting money in a deposit at the bank, it's about 5%. If you lend money to corporates, it's about 8%. For corporates internally, the cost for them to raise capital from investment and from borrowing money is about 12%. Corporates earn about 15% return if they're doing well. And then we look at individual projects, we get to 20%, 30%, and really venture capital companies typically look at 40% plus. So they might use a 40% or higher discount rate on your startup financial projections, and you've already seen how that diminishes the value of future money. Here you can see that if you discount 1,000 Rand 5 years in the future back to present value using a discount rate of 50%, it's worth only 132 Rands, just 13% of that number. Sorry, and again, that makes sense because the venture capital company doesn't have a lot of confidence that you will earn that 1,000 Rand 5 years into the future. Either you'll earn a lot more or you earn nothing. Your company might have gone down the tubes by that time. So, you know, you can see this dramatic reduction just by increasing the discount rate, the dramatic reduction in the value of that 1,000 Rands. And here's a diagram that shows at different risk levels what discount rates you can use. And I'll just talk you through the first and the last one. You'll get copies of this in the slide deck. So if you look at building a duplicate plant to make more of a currently made and sold product in response to presently high demand, that's a relatively low risk investment. Then you're looking at about 10 to 18%. But if you're looking at the bottom here, creating a startup company to go into the business of making a product not presently sold or even known to exist using unproven technologies, then we're looking at 50 to 70%. So not all of you are necessarily bringing into market completely unproven technologies. You might be bringing a new product, you might be using well understood technology, but a new product and to a customer segment presently served by other products. So then you might use a 30%, 40% discount rate. So you can see how you can use this sort of table to help you judge, you know, the level of risk of what you're trying to achieve. Let's now move on to discounted cash flow. So we've already spoken now about the time value of money. We've spoken about present value and future value. We've spoken about what discounting means. And I've briefly touched on what cash flow is. Cash flow is basically just actual money flowing in and out of your company's bank account. Think about when you actually paying not customers, your suppliers, when customers actually pay you, not when you raise an invoice, when the money actually flows into your bank, when you actually pay your employees, and when you actually pay expenses. Those are actual cash flows in and out of the business. So when you're doing valuation or looking at different financial options where you should buy or lease an asset, if you have to lease it, you know that you're going to be paying so much money for so many years into the future. If you're buying it, you know that you're going to be paying so much money right up front. And you want to relate those two. You will use NPV and IRR to relate those two. But you need to put all of those different things in present value terms. And that means you're going to discount those future cash flows. So that's really what discounted cash flow means. It's just discounting future cash flows back to the present time to calculate the present values. And you use the same present value equation that we just did, that we just showed the example of, that you calculated that 100,000 Rand answer to. So when you're doing this, a discounted cash flow calculation, you'll plot your money flows in years. You might have an initial investment, and you might have cash flows in different years that you're estimating. You're projecting those cash flows into the future. And you will just discount all those numbers back to the present time to get all of their present values. And then you can compare the present values to each other. Good. So now I've really given you all the basic tools you need to be able to understand and calculate net present value and internal rate of return. So just to say that after this topic, we'll take a quick break. So around about the 1 hour mark, we'll take a quick bathroom break. If you're getting tired and struggling to concentrate, then you can grab a coffee and stretch your legs, and we'll continue again. But so if you can hold out for the next 15 minutes, because this is probably the core of the discussion, the two things that you're here for, which is net present value and internal rate of return. So we already spoke about present value. We spoke about discounted cash flows. The net present value is really just the sum of all those discounted cash flows. So all we're doing is we make that series of cash flow projections. We know we have an investment in the beginning, and then we're hopefully going to earn some money over a number of years. But we want to know, what is the net value of all of those things? Are the inflows bigger than the outflows? I mean, that's the key question. So net present value tries to answer that question. It's the net value of all the current and future cash inflows and outflows. And that's all that it is. So really, it's the difference between the income and the cost. You're going to have some cash inflows. You're going to have some cash outflows. You calculate the present value of all those cash inflows and outflows. You add them all up, and that gives you the net present value. So really what you're doing is you're weighing up the project initial cost or the investment versus the net present value of all the cash flows later on. And the question that you want to answer is that net present value of all the cash flows coming in later bigger than my initial investment? That's the basic question. So you can see what question the NPV tries to answer. And we calculate that net present value just by discounting those cash flows back to the present time using that same present value equation that we spoke about earlier. So the NPV equation, and don't let this put you off, it's not that complex. All this sigma symbol means is that this is a sum. This means you're adding up all the numbers from the present time, which is time point 0, up to n years into the future, the end of the project. It might be 5 years. So from time point 0 to time point 5, add up the cash flows in every year. In every year, you're hopefully going to have some income, and you're going to have some expenses. So you subtract the expenses from the income for every year, from year 0 to year 5, or whatever the time period of the project is. And you can see this is the present value equation. You divide it by 1 plus the discount rate to the power n for every year of the calculation. That's really what net present value is. That's the way that it's written. It's really the cash flow in every year, the sum of the cash flows in every year discounted back to the present time. That's all that we're doing with net present value. And the rule for NPV is that you can accept the project if the NPV is bigger than 0, and you must reject the project if the NPV is less than 0. Because if you think about it, what an NPV of less than 0 means is that the costs in present value terms compared, the costs are really bigger than the income in present value terms that you're going to earn over the whole project. And if your costs are going to be bigger than your income, then you shouldn't be pursuing that project. I'll just expand this equation a little bit. So the net present value is equal to the cash flow now. And the cash flow now, we don't divide by 1 plus the discount rate to the power n, because it is already in present value terms, plus the cash flow in year 1 divided by 1 plus the discount rate to the power 1, plus the cash flow in year 2 divided by 1 plus the discount rate to the power 2, and so on until the year end. That's really what this sum symbol, the sigma symbol, denotes. So the second concept here then is the internal rate of return, and that's related to the net present value. Now, NPV, NPV is useful in that it gives us an answer in terms of the NP rule. You can accept a project if the NPV is bigger than 0, and you can reject it if it's less than 0. But it doesn't give us a sense of the size of the attractiveness, if you put it like that. It's only a yes or no. But we also want to get a sense of how attractive is this potential investment opportunity. And that's where the internal rate of return comes in. So we already know that if you think about it, the typical investment entails investing a sum of money in the beginning, in other words, a cash outflow, and then you expect a return in the future, a series of cash inflows, hopefully. I mean, you want to get the company profitable, and you hope to earn some cash coming back. But because the expense is at time point 0, but the cash that will be flowing, hopefully flowing in, is in the future, you can think that as you increase the discount rate, the expense stays as big as it is, but the future cash inflows are becoming smaller and smaller as you increase the discount rate. So this is what you see on this graph. We have NPV, net present value, plotted on the vertical axis, and we have increasing discount rate going to the right. And as we increase the discount rate, the net present value reduces and reduces and reduces, until at some point it actually crosses 0 and it becomes a negative net present value. So you can think, if you're discounting your startup at 50%, then it might give a negative NPV, and venture capital company will say, sorry, I'm not interested in investing in your company. The return is not promising enough. But the definition of internal rate of return is when you plot this NPV versus discount rate, that point where it crosses the x-axis is called the internal rate of return. And that's the definition of internal rate of return. It's the discount rate that makes the NPV of an investment 0. Now, this is a somewhat difficult concept to grasp, and it's difficult to understand. But you can also think of the internal rate of return just as a percentage return. So in this instance, the internal rate of return is 25%. You can think of it, it's somewhat analogous to an interest rate. So a return of 25% is quite attractive. That's quite an attractive project. It's a lot higher than the 5 or 6% interest you can earn in the bank. So this is a reasonably attractive project. Some more definitions. It's a discount rate where the present value of all the cash inflows and all the cash outflows are equal. But those are technical definitions. You don't have to worry too much about that. It's called internal rate of return because you don't need to assume a discount rate. Remember, you can see here this huge impact of discount rate on the NPV. As we vary the discount rate, the NPV varies dramatically, and it can influence our investment decisions. So if we use a discount rate of 10%, the NPV is positive, we will say the project must go ahead. If we assume a discount rate of 40%, the NPV is negative, we will say that the project shouldn't go ahead. So our assumption about the discount rate has a huge impact on the NPV. The big benefit of IRR is we don't have to make any assumption about the discount rate. So here's the equation for determining the internal rate of return. We set the NPV equal to 0. We already said that's the definition of internal rate of return. So that expanded NPV equation must be equal to 0. And that rate R is then the internal rate of return. It's the rate at which this right-hand side, all your cash flows become 0. So that's again a bit technical. Luckily, you don't have to calculate IRR manually. There's a built-in IRR function in spreadsheets like Excel and LibreOffice and so on, so that you can just calculate that. If you have your series of cash flows, You'll just calculate the internal rate of return. And in terms of decision making, the guideline is accept if the internal rate of return is bigger than a certain percentage and reject if it's lower than a certain percentage. And for existing established companies, they will use something called the weighted average cost of capital. Excuse me. That is what it costs them to borrow or to raise their money. They raise some of their money through borrowing money, and they raise some of their money through raising investment. And there's a rate that you can calculate, the weighted average cost of capital. It's how much it costs the company to borrow that money, to obtain that money that they can invest in their own projects and so on. And obviously, a company doesn't want to continue with a project if the return percentage that the project is going to earn them is lower than what it costs them to borrow or raise that money. I mean, that's just doesn't make sense, because then you'll be moving backwards. It's like you going to borrow money from the bank at 3%. Let's say you pay 7% interest, and then you go back to the bank and invest it at 3%. So you're paying 7% interest and you're only earning 3% interest. You're moving backwards. You're going to pay out more money than you're earning. So that's the same here. The company borrows and raises money. It costs them a certain amount. They don't want to invest in projects where the rate of return on the project is lower than what they're actually paying to borrow the money. And then if you're looking at, this is for existing companies. If you're looking at startup companies, we already spoke about, remember the risk-adjusted hurdle rate, where we looked at low risk projects, high risk projects. For a startup, it's generally in a higher risk domain. For venture capital companies, if they're going to decide whether to invest in your company or not, they're going to use a high hurdle rate here. They want to see what the rate of return your cash flow projections predict or forecast. So now we know these two terms. The question then is, which one should we use, net present value or internal rate of return? Which is the best when you're looking at evaluating different investment options, when you're considering different expense options like buying or leasing a building, and so forth. So net present value is an absolute measure. It gives you a number, and that, if that number is positive, it's a yes. If it's negative, it's a no. But it doesn't give you a sense of quantity or of level of attractiveness. It's just a yes or no. Internal rate of return is a relative measure. It gives you a percentage. That means you can easily compare projects. You can say, this one will earn me 20%, that one will earn me 40%, that one is more attractive. Of course, any of these calculations that you do, you have to be careful, because there's a lot of assumptions behind it. It might be that you made completely ridiculous assumptions about that 40% one and the 20% one is more realistic, and that might have been the better investment. But that's all the other things that, when a venture capital company or an angel investor, for example, looks at your company, that is the other stuff that they're going to dig into. They're not just going to look at the financials. They're going to look at the assumptions behind the financials. They're going to look at what market you're targeting. They're going to look at you as a team. What experience you have already in commercializing products or services, how the early market testing is going, all those risk reduction measures. And they're going to consider all of those things together with that internal rate of return and NPV calculation that you're doing. But good, let's continue here. So another difference between NPV and IRR is that the cash flows, assumption is that the cash flows are reinvested at the company's cost of capital. This is a bit technical, but the IRR assumes the cash flows are reinvested at the internal rate of return. That's actually a negative. I'll talk about that a little bit later, how you can overcome that problem. Also, the net present value takes into account the cost of capital. Remember, you're putting in there 15% or 25%. The internal rate of return doesn't take that into account, but you can explicitly compare it. So, it's still okay. And you can explicitly incorporate those in the calculations. With the NPV, it's difficult to determine the cost of capital. We already saw when I plotted the NPV versus the discount rate that the NPV reduces dramatically as we increase the discount rate to the right. And so your assumption that you make in terms of cost of capital has a big impact on the assessment. Whereas the internal rate of return, you don't have to make that assumption, and it's a bit more intuitive to understand. Everybody can understand that, 50% is more attractive than 5%. And then NPV, you can calculate for all negative or all positive cash flows. You cannot calculate IRR for those. but you can do a differential calculation between two options and calculate the IRR for that. So there are ways in which you can overcome this, and we don't have time to go into the details of all of these things today. So the question then, to answer the question, which should you use, net present value or internal rate of return? The answer is both. You should use both of these measures because they bring different things to the table. They have different strengths and weaknesses. You should always use both of these metrics when you're assessing any project or comparing different projects or making financial decisions. Use both of these metrics. We'll talk a little bit later after the break about some of the limitations and how to overcome them. As long as you're aware of those limitations, then you can use these metrics to help you make your financial decisions. So I think we're doing well on time. It's just about 11 o'clock. So we'll do the 5-minute break now. I don't know if there's one or two critical questions that I might answer now. Otherwise, we'll go for the break. I'll let Tari or Boon to guide me there. Okay, so I'm gonna make it exactly 5 minutes on my clock here. So please don't be late. We're gonna continue in exactly 5 minutes, and then we're gonna start with the exercises. So get ready. The Tech Tribe team is gonna help us divide into help divide you into smaller groups, and then we're gonna do some exercises. Oh, sorry. Let me just make a correction. First, we're going to do one exercise where I will show you the exercise, and the second exercise is the one that you will do. Okay, so the 5-minute break will start now.
Okay, we're back, and it looks like my mic is working again.
Yeah.
So a little technical glitch there, but I am back. So Sean, we do have 2 questions.
Okay.
Just thinking maybe we could start with those before we continue.
Sure.
So the first question is from Wiazwe, and their question is, interest rate is commonly used to price a loan, and most of us can relate to it. How does internal rate of return compare or relate to the interest rate? That is, how do you convert the IRR to interest rate to get a sense of how expensive a loan is or how attractive an investment is?
Great question. So you don't have to do any conversion. You can compare them directly. There are some limitations. IRR has a limitation which we'll talk about later. When you get to very high internal rates of return, it's distorted a little bit. It's got some distortions, but you can directly compare it to interest rates. So that's a good, it's a good comparison. So if we say an internal rate of return of 20%, you can compare it to an interest rate on your bank loan of 8 or 9% or 10%, or the interest rate that you earn when you deposit money at the bank of 6%. So certainly, when you do financial projections on an investment and you get a return, you get an internal rate of return of 10%, you have to think about the risk of that investment. If you will be getting a return of 10% on an investment in a bank account, that's a great investment. If you'll be getting a return of 10% on an investment in buying in investing in a startup company in a completely new field, in a country that you don't know, then 10% is not nearly enough to make that attractive. So there's also context around it, but you can most certainly compare internal rate of return with all the interest rates that you're familiar with and use that, and use that to give you a sense of the value of the comparative merit or value of the different projects or options, because those are different opportunities. We spoke about in the beginning about the opportunity cost. You have some money, you can put it in different things. You can put it in the bank and earn 6% interest, or you can invest it in the startup and potentially earn an internal rate of return of 30%. So you can directly compare them. I hope that answers the question.
I am sure it does. And one last question that we have before we continue is the IRR like break-even point?
No. Thanks again for the question. It's a good question. It's not the same thing. The break-even point refers to you know, when you have we'll actually get to that a little bit later. I'll some cash flow curves. If you think about it, initially, when you make an investment, you have an outflow of money. Even when you put the money into the bank, you don't have you can see that there in let's say you put it in a fixed deposit, then you don't have access to that money for a period of time. So you actually have a cash outflow. You can't use that cash until you get it back. And then later on, you have cash inflows. Now, the break-even point is when the cash flows until that, the break-even point refers to a time. It's a time into the future. Let's say, for example, you install solar panels on your roof, solar photovoltaic panels, and that reduces your electricity bill. So initially you spend 10,000 Rand on the solar panels, let's say 20,000 Rand on the solar panels, and you save 5,000 Rand a year. That means that after 4 years, you'll break even. That means I'm not talking about the time value of money now, and that's one of the problems, by the way, with break-even point, is that the standard break-even point doesn't consider the time value of money. But let's not consider time value of money. So you spend 20,000 Rand, it makes you save 5,000 Rand a year on your electricity bill. That means after 4 years, you've saved 20,000 Rand. That's the break-even point. You've earned back the same amount than you've invested without considering time value of money. So that's the break-even point. It actually refers to a time point. How far into the future will I have earned back the same amount of money that I put in? The internal rate of return is something completely different. It's like an interest rate. You can also calculate the break-even point, but it's of less interest. You know, a lot of people look at the break-even point. It's for me of less usefulness than NPV and IRR. You can use it, you know, and it indicates some measure of the value of something, because the faster the break-even point, of course, the faster the money pays back. But it doesn't say anything about what happens after the break-even point. You might be making losses for 20 years in a row after that, but the break-even point doesn't say anything about that. Whereas the NPV and the internal rate of return both look at all the cash flows in the whole future projection that you're doing. So I would say there are better measures to use than break-even point.
Okay, great. Thank you so much, Sean. Please remember, if you have any more questions throughout the session, you're welcome to post them in the chat and we'll go through it towards the end. And now I'll hand over to you, Sean, to continue.
Great. Thanks, Tari. So now we're going to look at example 1. We've spoken a lot about the impact of discount rate, and I want to show you an example of calculating the net present value. So you're familiar with the equation for NPV. So let's say that here we have we plot a series. This is a number of years. We plot this timeline, and we have a series of cash flows. And here you can see the familiar investment cash flow profile. You have an investment of 1 million in the first year and another investment of 300,000 in the second year. And then you're going to be earning some money, and that money is growing over time. So this is a typical cash flow series that you're hoping to see in a startup. And this is probably the type of thing that you'll present to the investor. And let's say we use a discount rate of 5%. Now we can calculate the net present value. And how we calculate the net present value is that we calculate the present value of each of these numbers. So here I did it. The present value of the value minus 1 million at time point 0 is minus 1 million. The present value of that minus 300,000 is minus 285, because we divide that minus 300,000 by 1 plus the discount rate of 5% to the power n, which is 1 in this instance, and so on. So we calculate the present value of each of those cash flows in the whole series, and we add them all up. This is just the sum of all those numbers, and we get a value 2.3 million. So we have a positive net present value of 2.3 million. And if you remember the yes or no decision, that means that if this series of cash flows can be realized, it seems to be an attractive investment, at least at a discount rate of 5%. Then this last number here, if I double click on that, you can see the function here. You can see that Excel has got an NPV function, but I have to caution you, NPV's function assumes that the first cash flow in the series starts at time point 1. So if we use just the NPV equation and we put we put D16 to L16, which is this cash flow series. If we put that whole cash flow series in there and the discount rate, and we do the calculation, it actually gives you the wrong answer. You have to remember when you use NPV in Excel to not include the value at time point 0 within the NPV equation. So if I double click here, the value at time point 0, D16, that number, I put outside the equation for NPV. Just remember that when you do these calculations in Excel. But one of the benefits of doing this sort of calculation in a spreadsheet is that you can now edit those input numbers and see what the impact is on the graph. So here you can see at time point 0, we have the -1,000,000. At time point 1, we have and I've plotted the present values here. We have that present value of the -300,000, which is -285. And then in year 2, we have that 90 and so on. And we have the positive values. But what I want to show is, so let's make that discount rate, for example, 0%. Then the present values and the future values are the same, as you can see. The future cash flow is 100, the present value is 100. You can see the shape of this curve. But keep your eyes on the shape of this curve as I increase that discount rate. So let's make it 5%. And then you see that those numbers further into the future reduce by more when we discount them back to the present time. So let's make the discount rate 10%. Look at how they shrink. We make the discount rate 20%, and you see all the time that this NPV is also reducing, because remember, the NPV is the sum of the discounted cash flows. And if we continue 25%, and let's make it 30%, suddenly we have a negative NPV. So somewhere between 25 and 30% is actually the internal rate of return, because that's where the NPV becomes 0. So I hope this gives you a sense of how this works. And you can see the impact of high discount rates on reducing the future cash flows closer to 0. So here is the same series of cash flows, but what I've done here is that I've just plotted it at different discount rates. So that's at a low discount rate. Well, in fact, 0 discount rate, 5%, 10%, 15, 20, 30, and 50%. And you can see how the future cash flows, the value in present value terms reduce as we increase the discount rate. And we calculated NPVs for all those different discount rates. Remember, in this previous one, for every discount rate, let's say 10%, we have an NPV. So if we plot, and here I've got at discount rate 0, 5, 10, 15, 20, 30, and 50, I have the NPVs. And at some point, the NPV becomes negative. So if we plot this series of NPVs against the discount rate, you get this familiar curve where as we increase the discount rate to the right, you see that the net present value reduces. And at some point, it crosses 0, and this is around about 25%, and that would be the internal rate of return as well. So you see this where this graph comes from that I showed you earlier about the internal rate of return. Now, let's look at another example here. This is a different cash flow series, -5, +3, and you can, let me plot that on a graph for you, and let's make that discount rate 0. So what you can see is that this cash flow series, if we plot it as a series of columns, you have a big negative number, that's your investment in the beginning, and then you have a series of positive numbers, and that's the cash flows afterwards. But internal rate of return is sensitive to large early cash inflows. Then it distorts the number. I'll talk about that limitation later. But I wanted to show you. So let's say here is the 0% discount rate. The red column is the cash flow, and the yellow column is the discounted cash flow. Now, at 0% discount rate, the discounted cash flow is the same as the cash flow. If we make it a 5% discount rate, now you can see the discounted cash flow, the yellow column, is lower than the cash flow, because when you discount that number back to present time, it becomes smaller. It's only the number at time point 0 that stays the same, as you know, because it's already in the present value. And as we increase that percentage, those numbers, those yellow columns shrink, because those future cash flows become less valuable. But notice also on the right-hand side here, I'm plotting the NPV. So at the 5% discount rate, the NPV is 3,800. At the 10% discount rate, the NPV is 2,900. At the 20% discount rate, it's 1,500. Because as you know, as you increase the discount rate, at some point it will cross the 0 axis. And this looks like it will be at about 37%. So if I enter there 37%, that's around about. Now the NPV is slightly negative, but the internal rate of return here, in other words, is just about 36 to 37%. And you can actually calculate NPV, IRR. So Excel is a built-in IRR function. So let's test this. IRR of that cash flow series should give us close to 37%. And there we go, 36%. And you've seen it yourself that if I make it about 36%, the NPV is close to 0. So this is what happens when you calculate the internal rate of return. So I hope these examples have helped you. You'll also receive a copy of this spreadsheet and the other one, the other example that we'll do just now. You'll receive a copy of this afterwards, so you can look at this yourself and go through the examples again. So let's now go to the second example. This is the one where you'll be grouped into groups. We'll also share the question here. Let me just change back to here. So here is example 2. And what we have is a given cost of capital of 15%. I give you the present value equation, which you're familiar with. And then we have 2 series of cash flows, project A and project B. We have a cash outflow at time point 0 in each of them. And then we have a series of cash inflows. And the question to you for your groups is, what is the NPV for each of these 2 projects? And when we answer that question, we want to also say which project is then the better project to pursue. So this is the question that I want you to do in the groups, and we will paste this picture, this question, this series of numbers in the chat so that you can access it there. So I'll do that just now. Let me just see. I want to send that to everyone. Let me give you a file. So I'll do that just now, but I'm going to hand over to Tari because Tari will now assist us in breaking us into groups.
Perfect. Thanks, Sean.
Yeah. I'll also leave the question up on the screen after I've shared that file with you again now. So there's the question. I'll just choose that. Hopefully it will upload that now.
Okay, thanks. So while Sean is uploading the second exercise into the chat, you'll see it now. You'll be able to open that and then work through it in your group. So what I will do is I'm going to assign you into breakaway rooms here. And you'll receive a prompt on your screen that says move to a specific room. Please accept that, and then it will automatically add you into different rooms. There'll be about 4 of you in each room. When you get into the room, please introduce yourselves, and then you can start working through the exercise. And I know Sean has got, I think this is the second exercise that he said he will be offering a free access to the financial modeling for entrepreneurs course 101 to the first group to come back with an answer. So you should be able to, so if your team has figured out the answer, you can click go back to the main room or leave breakaway room, and you'll come back in here, give us the answer, and you can get a free access to the financial modeling 101 course. So so please just keep a lookout on your screen. And then I'm going to open. So you should receive a prompt now. Please accept it. And if you haven't, please let me know, and then I will try reassign you into your room.
Well done, Phil. That's the right answer. Okay. I like it. That means we're doing well. Great. I see more groups coming back.
Unfortunately, Phil is part of our team, so he doesn't qualify.
Yeah.
But
well done.
I think that group 7 was first, and they indicate that they select project B, so that's good. Yeah. Well done, everybody else. I see there are at least three groups, and another one, Keumile says we select B. So great. I'm so I'm so happy because that means you know that things have that at least it was legible what I was saying here. So, or all of you know about NPV and IRR already, and it's just too easy for you. That's the other option, but hopefully it's been useful. I think we should probably start. Yeah, it's 25 to 12. So, Tari, if you can please get everybody back in the main room.
Yes, everyone's back in the main room, so we can continue.
Okay, great. So let me just see if I have the. Okay, this is fine. I don't see the other. Okay. So let's continue here. So well done. I see quite a few of you got the answer. The NPV for project A was 193K. The NPV for project B was 279K. I can take you through the calculations of the NPV. We have those two cash flow series that I provided. And then the NPV, if you remembered that, sorry, it's not easy to see it there in the blue background, but here you can see the formula. Remember to have the first number outside of the NPV formula. So the time point 0 is outside, B4 plus NPV of the, and Excel gives you guidance of the rate, which is C1, cost of capital, comma, in this case, C4 to F4, those four cash flows. Yeah.
We can't see your screen.
Oh. You know what? I'm so sorry. I was wondering why I didn't see the little thing over there. Let's start again. Thanks. So these are the two cash flow series that you were given. And then to calculate the NPV in Excel, there's an equation for NPV. But remember that the first time point at time point 0 should be outside the equation. So it's B4 plus NPV. And then if you click inside any formula in Excel, it will give you guidance as to what is required inside there. So it says rate and then the values. So we have the rate, which is 15%, comma, and then it's C4 to F4, the four values there. And you have the close brackets and you press enter, you have 193 and 279. So based on NPV, it seems that project 2 is better. However, there's going to be a twist in the tail here. And if we don't have time to let you calculate the IRR, but you know, it's a very simple thing. I'll show you now in the equation. If we calculate the IRR for each project, we get A 49% and B 35%. And now we have a problem, because if we looked at NPV, it seemed that project B is more attractive, as most of you correctly indicated. But now we calculate IRR, and IRR says project A is more attractive because it's 49%. So what do we do now? And this is actually due to a problem with IRR, and I wanted to illustrate that. IRR is pulled up to a higher number if you have a big initial cash inflow. You can see the cash inflow is 400, then 200, 150, whereas the second one has the more normal increase in cash inflow over time. And that big early number actually distorts the IRR. So therefore, when NPV and IRR conflict, we do not trust the IRR. We select a project with its highest NPV. But there is something you can do to overcome this problem with IRR, and I'll talk about it later. And that will just take away that problem, and then the NPV and the other calculation will actually agree. I can go back to the spreadsheet to just show you, and you'll get this spreadsheet as well. But there I calculated the IRR, and the IRR simply is just, the formula is just IRR of the first number to the last number. Here you don't have to put the first number outside the bracket. So that's as simple as that. And in fact, I can talk now. There's something called a modified IRR, which, you know, the IRR assumes that you, let's say that 400,000 Rand that you earned in year 1, it assumes that you reinvest that 400,000 and it earns interest at the same rate as the IRR. But I don't know of any place where you can reinvest money at 49% or 35% even. So the IRR distorts the positive impact of these positive cash flows. So that's why there is a function called the modified IRR. And luckily, you'll see that modified IRR is also built into Excel. But what the modified IRR does is it explicitly puts the finance rate and the reinvestment rate. So we already have the finance rate because we know our cost of capital is 15%. And let's say that we know that all the money we're going to earn on the project, we're going to put in the bank at 6%. Then the reinvestment rate will be 6%. And now if we calculate the modified IRR for these two cash flow series using the cash flow series, comma, the finance rate, comma, reinvestment rate, it now gives us 21% for project 1, project A, and 30% for project B. And now project B is more attractive, and that corresponds with NPV2, which is more attractive than NPV1. So it's very clear to us that project B is the better project here. So, yeah, I can't remember what I wanted to show here. I think that was just, you can do the same calculation by calculating the individual present values, adding them up, and you'll get the same net present value. So, well done to all of you, because it seems to me most teams actually got the correct answers for the NPV. So the answer also in terms of which project is best is the highest NPV, because, you know, if there's a conflict, we trust the NPV more than the IRR. But there's also problems with NPV. I chose, the reason we could compare these two NPVs directly is only because these initial investment amounts were exactly the same, plus the project durations were exactly the same, because there's some limitations of NPV and IRR. So, but let me first get back to IRR, because I'm going off on a sidetrack there. So this is a typical investment cash flow. You have a series of cash outflows, and you then have a series of cash inflows. And if you think about the examples that I showed you and the ones that you just did, you have those initial investment outflows, and then you have the series of cash inflows over a number of years. So the internal rate of return works well for the typical investment cash flow profile. This sort of cash flow profile: initial investment followed by a series of growing returns, and you can use IRR for that. So it's but there are some other ones that you can't use IRR for. So I want to say that it's always useful to plot this in a graph, the cash flow projections, if you want to calculate in NPV and IRR, just to check what sort of profile you have, because internal rate of return does not work for these sorts of cash flow profiles. For example, this one has a small positive set of cash flows and then a large number of negative cash flows. Now, the weird thing is that if you calculate IRR in Excel, it will give you exactly the same result for this than for this, when you can clearly see that here you have only a few positive inflows and a large number of negative outflows, whereas here you have a small negative outflow and a large number of positive inflows. So clearly they can't be the same. But if you just blindly calculate the internal rate of return, it's going to give you exactly the same result, while it's not. So that's why you can't use IRR for this sort of strange cash flow. And similarly, this series of cash flows changes sign more than once. So you can see there's a series of outflows, then there's a series of inflows, and then there's a series of outflows. And if you try and calculate the internal rate of return for this, it'll give you two answers, because there are changes in the sign of the cumulative cash flow, or of the cash flows. And then you don't know which of those values are correct. So be careful. Don't use internal rate of return blindly for these sorts of weird cash flows. It's better to just use net present value if you have these sorts of weird cash flows. So my tips for using internal rate of return is, don't use it where the cash flow profile is significantly different to the typical investment profile, where you have an initial set of outflows followed by a growing series of inflows. Don't use internal rate of return to compare cash flow streams where you have different profiles. Don't overinterpret the internal rate of return magnitude and rates where it's substantially different to real financing and reinvestment rates. In other words, if you get to internal rates of return of 40, 50, 60%, just remember that it distorts those numbers. It's better to calculate the modified internal rate of return, which has more realistic assumptions about what you do with the incoming cash flows. So then rather use NPV and the modified internal rate of return. And then you cannot calculate an internal rate of return for entirely positive or entirely negative cash flow streams. So you can ask, well, where do we have entirely negative cash flow streams? It's where, for example, you're comparing the cost of two different options. Should you buy the building or should you rent the building? Both of them are cash outflows, but the timing of the cash outflows and the magnitudes are different. And if you want to compare them, you cannot use internal rate of return, but you can use net present value. So there are three key issues with NPV and IRR, and I already touched on them, and the examples already showed a little bit of them. NPV has a scale problem. In other words, the NPV doesn't take the size of the initial investment into account. In the exercise that I gave you, I specifically chose two series of cash flows that at the same initial investment so that you could compare them. But you cannot compare NPVs of two different investments where the initial investment amount is different. Also, I just spoke about the timing distortion problem of internal rate of return. It's distorted by large early cash flows. Then it gives you strange results. And then NPV has a horizon problem. It doesn't take different project durations into account. One project might be 4 years, the other might be 6 years. And think about things like you buy a piece of equipment. The one piece of equipment might last you 5 years, the other one might last you 10 years. Then clearly it should impact on what the net present value or the net cost of those different pieces of equipment is. So these are the key problems with NPV and IRR. But there are solutions to all of these problems. So in terms of NPV not taking the size of the initial investment into account, you can use something called the excess present value index. In terms of the IRR distortion, I already spoke about that you can use the modified IRR. And then to account for the different project durations, you can use something called the equivalent annual cash flow or the unit cost. I mean, we don't have time today to go into all the details of these indexes or these related metrics, because they're all related to NPV and IRR. They're just modifications of NPV and IRR to overcome some of the limitations. But for those of you, the team, the people that won the free courses, Financial Modeling for Entrepreneurs 101, is really an extension of what we cover today. And there I cover in more detail and with examples all of these other metrics and how to use them in practice. Also, this is let me just close this thing here. This is a free guide which you can get as a download from the Moolman Institute. And in fact, we can distribute it, Tari, afterwards as well. But you can, at the bottom of the homepage, if you enter your email address, you'll get an email with a link to download this, which is a full guide with examples on other pages and with definitions and with the equations, and also telling you what the equivalent function in Excel is that you can use to calculate these different things. But it tells you step by step how to do, for example, a cost comparison between different options like buying or leasing. And it says, for example, step 1, calculate or estimate the cash flows, calculate the NPVs. If the project lives are different, then you have to calculate the unit cost or the capitalized cost and so on. So it guides you through step by step how to do cost comparisons, and it guides you step by step how to do profitability calculations. And I think that is it. I think we did reasonably well on time. I apologize if I went a little bit quickly there at the end. You're welcome to ask a few questions now, and then I can see if I can answer them.
Perfect. Thanks, Sean. We do have some questions that were submitted during registration. So maybe we can just answer just a couple of those. There's a question here from Patrick in South Africa. And his question is, how do you perform NPV analysis on irregular cash flows based on estimated inputs? For example, a startup, what source of information? What source of information would they use?
So, in fact, again, we didn't have time to cover it today, but if the cash flows are not periodic, there is a function called XNPV. That's also built into Excel. You can use that. Let's say you have a cash flow after 3 months, and then after 9 months, and then after 15 months. It's not periodic. It's not all 1 year, 2 year, 3 year, 4 year. It's the time span between those cash flows vary. Then you can use a function called XNPV, and there's also a function called XIRR. And then then you can use cash flows that are across different time periods, or that's not periodic. I don't know if that's the. Oh, I think the second part of the question is, where do you get all the input information? I mean, that's a whole, in the financial modeling for entrepreneurs course series, the fourth course is build your own financial model. And there I spend a lot of time on how to actually come up with these financial projections, because, you need a series of financial projections for your company to be able to use NPV and IRR. But, that's a whole exercise, because you have to gather information. It's about building, looking at your business model. What are you selling to whom? What price are you going to sell it at? What are your volume projections? What's the total market size? What's the realistic portion of the market that you can capture? Are you partnering with somebody who's got X percentage market share? This is their current sales. You're hoping to, partner with them and put it in 10% of their products or whatever. But you have to make a whole set of assumptions, do research, speak to people, gather some information to be able to come up with a reasonably realistic. I mean, it's very difficult to come up with so-called realistic financial projections, because of course the tendency is that you are very optimistic about what you can achieve with your business, and you believe you're going to shoot out the stars with what you're going to achieve. But somehow you have to connect it to reality, and that's the whole process of gathering the information. Also, when you build a set of financials, when you build a financial model for your business, you're doing those cash flow projections. As I showed earlier in that spreadsheet where I could change the discount rate and see the impact on the net present value, the big benefit is once you've built a financial model for your business, you can change assumptions and see what the impact of that is on the profitability. For example, you can change cost of some of your input, some of your raw materials. What happens if your raw material price goes up by 20%? Are you still profitable? What happens if you can only achieve a price of 80% of what you thought you can achieve? How do these different things impact on the financial viability of your business? So then you can do what they call sensitivity analysis. You can look at different scenarios if the market changes in this way. And then you see, when you do that, that's the power of having that financial model, because then you see, oh, the biggest impact on my financial viability is my selling price. So if I want to get more confidence in my own financial model, I should focus on trying to get a more accurate selling price. Maybe I look at competitive products, what they sell for in the market. Maybe I do a small test. I manufacture a small sample, a minimum viable product, and I try and sell it to a few people, and I see if I can actually sell it at that price. Because I know if I can confirm that assumption, if we think back about what we spoke about risk earlier, all of these things are reductions in risk. So all my assumptions in my financial model represent assumptions that have a risk attached to them. Can I really sell my product for this price in the market? Can I really sell my service for this price? So when you've built a financial model, seeing which of these factors have the biggest impact on your profitability tells you also where to focus on making the model more, getting more confidence in the model, what aspects you should focus on. Also, it gives you an idea of what are really the things that will make your business more profitable. It gives you insights into what costs are the important things to reduce, what market segment might be the most profitable, and all these sorts of things. So that's really the power of doing these sorts of exercises. You'll gain a lot of understanding about your own business, and it can help you make it more profitable.
Okay, just keeping an eye on time. And one last question here from Umpile is, what is the practical application of NPV and IRR when making a investment decision? I think you might have covered this, but just a quick summary of that.
No, thanks. It's a good question, because I didn't necessarily cover that yet at the end explicitly. You would, one of the most common ways, in fact, there's lots of methods to value your business, but the sort of Goldilocks, if I mean, there are very simple methods that people use. Oh, okay. I project a return of so much in year 5, and I use a price earnings ratio of 10, so my company is this value. Or they use the so-called Dave Burkus method, which gives you a bit, $500,000 if I have a product in the market already, $500,000 if I have a strong team, or whatever. There are these quick and dirty methods, but there's always a balance. There are very detailed methods that you can spend a lot of time on building financial models and doing valuation using very sophisticated methods. But the point is that the uncertainty that's built into the assumptions that you make are so big that it's not worth it to go into that much detail when you build the model. But then on the other end of the extreme, you have too simple models. The assumptions are so many that it's almost divorced from reality and the valuation is meaningless. So there's a golden middle somewhere where there's a certain level of effort that you should put in. Not too much, but not too little. You have to put in amount of effort to do that valuation. And that gold standard is really what they call the discounted cash flow method. It's one of the income valuation methods. And what it does is what I said earlier about building a financial model for your business. In other words, producing cash flow, producing financial statements and cash flow projections for your business over, say, 3 to 5 years. Doesn't make sense to do it for longer than 5 years because we know about the big discount rates and the risk, and projecting more than 5 years into the future is almost meaningless because it's too uncertain. But you produce a series of the financials and a series of cash flows for your business for 3 to 5 years, and then you use NPV, the net present value, to calculate the present value of all those cash flows, because you calculate the present value of the investment plus the return that you are claiming that you're going to be achieving with your business. And that NPV number that you end up with will be the valuation for the business. But as you saw earlier, what you assume on that discount rate makes a huge impact on what that value is. So one of the things that's likely going to happen is an argument with the investors about what discount rate you should assume. And also they will look with a magnifying glass at what did you do there in terms of your key assumptions. Is your selling price realistic? Is your sales volumes realistic? Are your raw material costs realistic? Is your salaries realistic for the people? Are your other expenses between 10 and 20% of your revenue or not? If you say, oh, all my expenses is going to be 3% of revenue, then I don't have to look at anything else. I'll tell you immediately that it's not true, that you have not done a realistic set of financials. But that's the stuff that they will look at. And I cover it in more detail in the course series, but that's sort of the quick answer.
Perfect. Thank you so much, Sean. Thank you for all of this. I know there was a lot of maths language there that might have flown over my head a little, but I will be sure to make use of the 20% discount that you're offering us for your financial modeling courses. And I think not just me, I think all the attendees here, Sean is offering us a 20% discount on his financial modeling courses, so we can delve a lot deeper into all of this and what this means for our businesses and building how to build a financial model that makes sense, that investors will nitpick at, and is one, that will help us in building and growing our business. So thank you so much, Sean. Please, everyone, thank you so much. On behalf of the Tech Tribe community, I want to thank you all for attending. Thank you for joining us. Please watch out for an email from my colleague, Lindy Nkosi. She will send you all the details on how you can get that 20% discount. She'll send you all the handouts and the exercises that Sean has gone through today. And lastly, please save the date, June 23rd, for the next masterclass with Sean on understanding and analyzing financial statements. I know that will be very valuable for you all. So please save the date to register. We'll share all of those with you in the coming week. And once again, thank you so much, Sean. This has been a very useful and helpful 2 hours. And we look forward to the next masterclass in June. For me, Tarisiro, your host, thank you all for joining us, and we'll see you again in June. Thank you. Goodbye.
Thanks. Bye-bye, everyone.